Revenues are defined as the amount of inflowing assets from the sale or providing of goods or services to customers. This amount is usually reflected in the sales price charged to customers. Okay, now a lot of words here. Let's kind of make sure we can focus and really understand what revenues means. Okay, typically when we make a sale to a customer, the amount of cash received is a reflection of the sales revenues, which effectively is the amount of the sales price. Revenues, again, well, usually we make sales and it generates inflowing, usually cash, but in this particular case, maybe even accounts receivable from the sale or providing of goods or services to customers. This amount of revenues is usually reflected in the sales price charged to the customer, which if we made a sale on account would be the amount of the account receivable. That's how much we would charge them, the sales price. Now this is important, and students really sometimes get a little confused as we try to apply this definition of revenues. I want you to note that revenues are not the asset received, but simply a description of why we received the asset. So sales revenues is a descriptive term of why we received cash, not of the cash. The cash is an asset. Sales revenues is a description of why we received it. For example, sales revenues of $100 means that $100 worth of assets were received from a customer upon the sale of a product rather than from borrowing it or some owner's contribution. Now, usually when we reflect revenues on an income statement, we want to be more descriptive and explain really what we did in order to earn those revenues. What kinds of goods or services were provided. If we sell some merchandise, we typically refer to the revenues as sales revenues. It's a little bit more descriptive term, and it reflects the sales price. If in fact we're in a business that doesn't sell merchandise, instead we provide consulting services to customers, well, we charge them a fee for this. And so when we receive from our customers, these various fees, usually we'll receive it in the form of cash, that is revenue to us, and we want to describe why we received that cash. The reason is because we provided some consulting services, so let's call it consulting fee revenue. Some banks, the goods and services they provide are really to make loans to you on car loans or house loans. Banks are in the business of loaning money, which is really a service to their customers, but they generate some income or revenue from the loaning of those funds, making those loans, called interest. So in fact, if the bank receives cash as an interest payment from a customer, they really have revenues. That's an inflow of an asset, cash, as a result of providing goods and services to the customer. We'll call it interest revenue. Now let's take a look at the definition of expense. Expenses, well, the amount of outflowing assets or the incurring of liabilities requiring the future outflow of assets and represents a cost of providing goods or services for sale. Now, again, let me work on this definition with you. First, let's ignore that information there in the parenthesis. Let's just deal with that first thing. The amount of outflowing assets that represents a cost of providing goods or services. See, this is what happens in a business. We provide goods and services to customers and they give us assets. That's the price they pay, usually cash. But when we may incur some costs of providing those goods and services, and usually we give up assets as a cost of providing the goods and services. You got assets coming in from sales, you got assets going out as a reflection of the cost of providing those services. The outflowing assets, or the amount of those outflowing assets, represents your expenses in providing the goods or services to customers. Now, I do want to note that inside the parentheses here, it is the amount of outflowing assets or the incurring of obligations or liabilities requiring the future outflow of an asset. which reflects an expense. So I'm talking about incurring some outflow of assets to pay a cost of doing business, or incurring an obligation requiring the future outflow of assets to pay a cost of doing business will be reflected as an expense. Well, now, again, just a reminder here. This term, expense, is a term which describes why an asset is given up or will be given up in the future. It isn't a description of the asset given up. The asset may be cash. What we're trying to do here is explain why the cash is given up. Were we paying off some debt? Are we paying a dividend to the owners? Or is this a cost of providing the services to our customers? For example, wage expense of $500 means that $500 worth of assets were paid out, probably cash, to employees, or will be paid out to employees in the future. This represents a cost incurred in operating the business. If I take $500 worth of cash assets and pay it to employees or helping me provide goods and services, this is an expense in the amount of the outflowing asset. Usually, when we actually reflect expenses on the income statement, we'll try and be as descriptive as possible. Explain usually what kind of cost it was. For example, if we paid wages to employees, let's call it employee expense or wage expense. One of the most difficult expenses for students to kind of get a hold of is referred to as cost of goods sold. One of the reasons why students don't like this is because it doesn't have the word expense in it. I mean, it's easy to identify an expense if you just call it an expense. Typically, we use the term cost of goods sold and don't really use the term expense. But maybe I'll do it just to kind of make you feel better about this kind of expense for a while. Instead of calling it cost of goods sold, let's call it cost of goods sold expense. Now, this is an expense representing the cost of inventory that's being sold to customers. Now, you've got another problem. Now let's look at the solution to this problem. The first part, A, asked, how are companies' profits calculated? Well, the term profit is synonymous with earnings or net income. Those are all the same term or language. Revenues minus expenses equals net income or profit or earnings. Well, then next, let's go ahead and define revenues, expenses, and I also want you to define dividends. Revenues describe the amount of asset inflows, usually cash, received from a customer as a result of sales to the customer. It's typically the sales price. Expenses describe the amount of asset outflows or the incurring of an obligation requiring the future outflow of an asset, or the outflow of an asset that represents a cost of providing the goods or services. Dividends are not an expense. Dividends are a celebration of profits. Let me ask you this. Are owners happy when they have lots of expenses? I mean, really, if you're an owner, are you really happy when, the business say, wow, we got lots of expenses this year? No, that's terrible. I mean, the more expenses, the less your net income. How do you feel if they say, hey, baby, we've got a lot of dividends? Dividends are great because dividends means that the company has made a lot of profits and are now going to distribute those profits. After having paid all the expenses, now you have profits, and dividends are a distribution of those profits to the owner. It's a celebration of our success in terms of revenues in excess of expenses. Number C, what are the two ways that owners may provide capital to a business? This is kind of a review. What are the two ways that owners provide capital or resources to a business? Well, one way is, you'll remember in Stephen's Sweet Shop, he put $100 into the business. He was providing capital to the business. We called that an increase in owner's equity because he made a capital contribution. We called it capital stock or capital contribution. The second way that owners provide resources to a business is by allowing the profits, the resources created through profitable operations, the excess of assets received from sales less assets or future asset outflows that represent costs of providing goods and services, that excess resources, by allowing them to be retained in the business rather than having them paid out in dividends. So the other way that owners provide resources is by allowing the profits to be retained in the business rather than taking them out in the form of dividends. The last part of this question asked you to simply calculate net income from a series of items of information. Well, net income is by definition not sales revenues, any kind of revenue, less expenses. So from this information, let's make sure we can identify our revenues and expenses. The first item on this is cash. Well, this cash of $10,000, is that revenue? It is not. Cash is an asset. Revenues are a description of why we received an asset. You see, we could have received this cash, this $10,000, from capital contributions from owners. We could have borrowed that $10,000 of cash. Sales revenues describes how much was received from customers as a result of making sales to them. On this list, if you look down, you'll find sales revenues as $75,000. Now, this $75,000 means that we received assets, usually cash, from customers equal to $75,000, which is probably the sales price of all of our sales during that period of time. Well, then you're going to say, well, if that's sales revenues, why doesn't that $75,000, isn't it included in cash? I mean, we've only got cash of $10,000. It should be at least $75,000. Well, that's because cash is also being used to pay various expenses and maybe to pay off obligations or even to pay dividends. See, there may be a lot of reasons why cash is coming in or going out. Sales revenues is simply one reason why cash comes in. So to look at cash and say that's my revenue would be totally inappropriate. This is smoke. Smoke? Wait a second, Norm. You're fooling us here. Why are you including smoke in a problem like this? Well, the fact of the matter is you are going to see smoke because in business you need to distinguish the information that's relevant from that is irrelevant, and there's tons of irrelevant information in business. As far as I'm concerned, this kind of smoke, irrelevant information in a problem, really tests you more intelligently as to whether you really understand the material. Accounts receivable is also smoke. That's an asset. Now, we may have received some of those accounts receivable from sales to customers, which would be included in sales revenues, but the total amount of sales revenues is $75,000, which reflects the total amount of sales price to customers, or in other words, the assets we've received from customers as payment of the sales price. Now you have to identify any other revenues, and I don't see any on there. Are there any expenses? Some people may say, well, wage payable, that's an expense, isn't it? I mean, you're going to have to pay out cash in the future. But wage payable is smoke. That's a liability. Oh, yes, there may be some cost of doing business associated. We've paid, the fact that you owe some wages at this point in time, that you're going to have to pay in the future, is a reflection of one of the costs of doing business, but we may have paid additional wages along the way. We'll keep track of wage expense, the total cost associated with all of our wages during the period, not just that amount that's payable in the future, in an account referred to as wage expense. This total of $35,000 is the separate, distinct information about our total cost of employee wages. The only other expense reflected here, and again it has the language expense, is rent expense, $25,000. This dividends down here is not an expense. It's not a cost of doing business. It's smoke. Capital stock is reflected as owner's equity section of the balance sheet. It's smoke. So net income is the simple sales revenues minus wage expense minus rent expense, or net income of $15,000.